Warren Buffett started making money as a kid, but it wasn't his first business that made him a billionaire. His secret isn't what you think, and if you don't get it, you'll miss out on an opportunity that very few ever see. Because here's the truth, wealth isn't built by being clever, but by understanding things that most people find boring. Today I'll show you how his investment strategy, one that makes most people yawn, ended up creating one of the greatest fortunes in history. Warren Buffett didn't become a billionaire overnight. His journey was shaped by a series of smart decisions that go all the way back to his childhood. His story begins in the heart of America. Warren didn't have the luxury of growing up in a wealthy family or with any special financial advantages. But even as a kid, he showed a rare entrepreneurial mindset. At just 6 years old, he started his first business, selling chewing gum and bottles of Coca-Cola door to door. It might sound like child's play, but it taught him discipline and the importance of making a strong first impression. Then at age 11, he made a decision that would change his life. He bought his first shares of stock. The investment? A total of $114. A meaningful sum for a kid at the time. And it wasn't random. Even though he didn't fully understand how the markets worked yet, his curiosity led him to study the world of investing. In 1947, Warren enrolled at the University of Nebraska, where his passion for finance and business grew stronger every day. And at just 20 years old, he made one of the most important decisions of his life. He moved to New York to attend Columbia Business School. There, he met the man who would change his destiny, Benjamin Graham, the father of value investing. Graham's strict analytical approach to investing taught Buffett a lesson that would become the foundation of everything he did in the years to come. Invest in companies that are undervalued by the market, but have strong fundamentals and a lasting competitive edge. But there was one more thing that made the difference. Buffett didn't just go with the flow. His real strength was developing independent thinking, staying immune to trends and hype. It's a trait that has defined his entire career. Now let's fast forward a bit. In 1956, Warren Buffett founded his first investment firm, Buffett Partnership Limited. At the time, the market was going through turbulent phases, but Buffett was in a unique position. He had developed an analytical method that allowed him to look beyond daily market swings and focus on something far more important, a company's intrinsic value. His strategy was clear and simple. Buy undervalued companies with a strong and lasting competitive advantage. It wasn't about picking up cheap stocks just because the price was low. It was about identifying businesses that, even if currently out of favor, had solid fundamentals and long-term growth potential. Buffett wasn't drawn to volatile stocks or market trends. On the contrary, he looked for companies that could deliver stable and predictable cash flows. The key to his success was a long-term vision. While other investors chased quick profits, he focused on steady, reliable returns over time. That approach would make him famous and eventually allow him to build a financial empire. A classic example, Coca-Cola. In 1988, Warren Buffett bought a massive stake in the company for around $1 billion. He knew Coca-Cola had an unbeatable brand, a global distribution network, and strong profit margins. At the time, many considered it a risky move. Coca-Cola wasn't exactly a hot stock anymore. But Buffett had a clear vision: buy a great company at a fair price. Over the years, that investment grew nearly 30 times in value, becoming one of the most profitable positions of his entire career. And that's the heart of his philosophy. Don't chase lucky breaks. Make strategic, thoughtful investments that gain value over time. This buy and hold strategy made all the difference. It didn't just lead to exponential growth in his capital, it also allowed Buffett to sidestep the impact of short-term market noise. In other words, rather than trying to guess the near future, he focuses on what's truly solid and predictable. Now that we've seen how Warren Buffett built his fortune by focusing on valuable companies, there's a crucial aspect we can't overlook: his investment philosophy. One of the most important lessons Buffett has taught us is to protect your capital above all else. His famous rule number 1 of investing is never lose money. And rule number 2, never forget rule number 1. This simple yet powerful principle is the foundation of his approach to investing, Buffett has never been the kind of investor to take unnecessary risks. He's never chased short-term speculation or easy wins. He's always focused on one thing: safety. So what does safety mean for Warren Buffett? It means avoiding uncertainty and unpredictability. Before investing in any company, Buffett wants to be sure the risk is minimal and that the investment can deliver steady, predictable returns over the long term. But there's another key concept at the core of his approach: investing in companies with a strong competitive advantage. This is what Buffett calls an economic moat. It's the edge a company has over its competitors, something that protects it and allows it to continue generating profits over time, even as markets evolve. A perfect example of this strategy is his investment in American Express. In the 1960s, the company faced a crisis due to a fraud scandal that damaged its reputation. But Buffett quickly recognized that American Express had a unique competitive edge: a trusted brand and a global credit card network. He made a long-term bet that paid off as the company bounced back and its value soared. Buffett doesn't just look for companies that are cheap or undervalued. He looks for companies with enduring advantages: a strong brand, a dominant market position, or a product consumers can't live without. That's the strategy that made him famous and built his empire. Warren Buffett's investment philosophy strikes the perfect balance between safety and long-term growth. The goal isn't to be the richest or the fastest. It's to create steady, reliable growth while minimizing risk. It's no coincidence that one of his favorite sayings is, "Time is the friend of the wonderful business, the enemy of the mediocre." That's his great insight. It's not about making constant moves. It's about making the right moves and having the patience to let them play out over time. Now that we've explored how Warren Buffett built his fortune, it's time to ask the most important question: what can we learn from him, and how can we apply these lessons to our own investments? Buffett has taught us a lot over the years, but there are three fundamental lessons that every investor, beginner or experienced, absolutely needs to understand. Lesson 1: safety first. The first and most important lesson is simple: never risk more than you're willing to lose. Buffett has always emphasized that the number one goal of investing is capital preservation. Making money comes second. Every time you evaluate a company to invest in, you should ask yourself one key question: what could go wrong? If the answer reveals too much risk, or if you can't reasonably predict how the business will perform in the years ahead, it's probably best to walk away. This mindset protects you from emotional or impulsive decisions that could damage your long-term financial health. Lesson 2: the power of compounding and patience. The second lesson is the magic of compounding. Buffett has always said that compounding is the secret behind his wealth. By reinvesting the profits generated by his companies, he's been able to create exponential growth over time. To truly grasp this concept, think of it like planting a tree. You plant it today, let it grow undisturbed, and one day you have a forest. Investing works the same way. The longer you let your money grow without rushing or constantly interfering, the greater your long-term returns. Patience and discipline are critical. Lesson 3: invest in yourself. The third lesson might be the most important of all. Invest in yourself. Buffett has often said that the best investment anyone can make is in their own knowledge and skills. The time you spend learning, reading, and improving yourself is the most valuable capital you'll ever put to work. If you want to become a better investor, the smartest thing you can do is build your financial education. Read books, take courses, stay up to date with investment strategies. These habits will give you the highest return in the long run. Warren Buffett became who he is not just because of his investment skills, but because he dedicated decades to studying and constantly learning. If you want to follow in his footsteps, remember this simple truth: never stop learning. In conclusion, Warren Buffett has shown us that the secret to successful investing doesn't lie in chasing lucky breaks. It lies in discipline, long-term thinking, and investing in companies with a durable competitive advantage. Buffett built his fortune not just through intelligence, but through patience, the ability to think long-term, and a refusal to be swayed by short-term market noise. If you want to follow his example and build a strong financial future, You need to make thoughtful decisions, avoid unnecessary risks, and most importantly, develop a long-term vision. Don't expect overnight results. Focus instead on building a solid foundation that allows your capital to grow over time. And remember, there's no magic formula for getting rich quick. Buffett's real secret is his willingness to be patient, stay disciplined, and most of all, invest in himself. Now take a moment to reflect. Which of Buffett's lessons can you start applying to your investments today? And what are you doing to improve your financial education?